Imagine waking up one morning and realizing the most powerful weapon on Earth isn't a missile, a currency, or an army. It's a spreadsheet. Rows of numbers. Deadlines. Interest rates measured in decimals. And yet, entire nations move when those numbers move. Because debt doesn't just borrow money from the future. It quietly rewrites who gets to decide the present. That sounds abstract. Almost boring. Until you realize debt determines which countries go to war, which governments fall, which corporations survive, and which citizens pay the bill. Not with cash. With leverage. And right now, that leverage is everywhere. This matters now because global debt has passed $300 trillion. That's not a typo. 300 trillion. That's more than 3 times what the entire world produces in a year. And somehow, the system is still standing. Barely. To understand how we got here, you have to stop thinking about debt as a personal finance problem. Debt isn't a mistake. It's a design choice. At its core, debt is simple. Someone wants something now. They don't have the money. Someone else does. A promise is made. Money now. More money later. That's it. But scale that up from a credit card, to a corporation, to a government, to an entire global economy. And debt stops being a tool. It becomes a structure. Here's the part nobody tells you. Debt doesn't just create obligation. It creates hierarchy. The one who owes must listen. The one who lends gets options. If you owe your friend $50, it's awkward. If you owe the bank 50 million, it's policy. If your country owes another country hundreds of billions, that's geopolitics. This is where power quietly shifts. Historically, power came from land, then industry, then oil. Now, it comes from balance sheets. Let's rewind. After World War II, the world was broke. Literally. Europe was rubble. Asia was shattered. Currencies were unstable. Trust was gone. So the global system rebuilt itself around debt. Institutions were created. Rules were written. Money was standardized. Not because debt was evil, but because it was efficient. Debt allowed growth without waiting. Rebuilding without savings. Expansion without patience. It worked. For decades. Governments borrowed to build highways. Companies borrowed to scale factories. Households borrowed to buy homes. Economic growth accelerated. Living standards rose. Debt became normal. Necessary even. But here's the hidden mechanism. Debt works beautifully, as long as growth outpaces interest. That's the deal. That's the math. If the economy grows faster than the cost of borrowing, debt shrinks relative to income. If it doesn't, debt starts eating the future. Quietly. Relentlessly. And once that balance flips, power shifts. Because when growth slows, debt doesn't. Interest doesn't care about recessions. Deadlines don't pause for politics. Creditors still expect payment. That's when leverage appears. Let's make this painfully simple. Imagine a country earns $100 a year. It owes $200. Interest is 5%. That's $10 just to stand still. If growth is strong, no problem. If growth stalls? Now that country must cut spending, raise taxes, or borrow more. All three hurt someone. And the people deciding how it hurts aren't voters. They're lenders. This is how debt reshapes power without ever firing a shot. Because debt limits choices. A government drowning in debt can't freely invest. Can't easily stimulate. Can't ignore markets. Every decision runs through one question. How will this affect confidence? Not confidence of citizens. Confidence of creditors. That's why you'll hear phrases like market reaction, treated as sacred. Markets don't vote. They don't protest. They don't riot. They just leave. And when they do, currencies collapse, borrowing costs spike, and governments panic. So policy bends. Not toward ideal outcomes. Toward survivable ones. This is where the irony kicks in. Debt is sold as freedom. Freedom to grow faster. Freedom to invest now. Freedom to smooth crises. But large-scale debt creates the opposite. Constraint. The more you owe, the fewer moves you have. And the system knows this. That's why debt isn't evenly distributed. Some entities borrow cheaply. Others pay premiums. Some can roll debt forever. Others get cut off overnight. This is where economic power concentrates. The biggest borrowers often get the best terms. Why? Because if they fail, everyone feels it. That's not fairness. That's fear. Banks lend to governments because governments tax. Governments borrow because citizens tolerate it. Corporations borrow because markets expect growth. It becomes circular. And fragile. Here's the uncomfortable math nobody likes to say out loud. Modern economies don't just use debt. They require it. If everyone suddenly paid off their debt, the system would shrink. Violently. Because debt isn't sitting idle. It's someone else's asset. Your loan is someone's income. Your interest payment is someone's yield. Your mortgage is someone's pension. So when debt stops growing, something else has to fall. That's why central banks intervene. They lower interest rates. They buy bonds. They inject liquidity. Not to be generous, but to prevent collapse. Debt has become the load-bearing wall of the economy. And once that happens, power shifts to whoever controls the flow. Interest rates become political. Bond markets become judges. Credit ratings become weapons. A downgrade can cost billions. A rate hike can topple governments. And none of it requires intent. That's the scariest part. No conspiracy. No villain. Just math playing out at scale. Let's talk about who wins. Creditors gain leverage. Asset owners benefit from inflation. Large institutions get bailouts. And who loses? Wage earners. Savers. Young people entering a system already saturated with promises made decades ago. Debt pulls value forward in time. Future workers pay for past growth. Future taxpayers service yesterday's optimism. That's not inherently immoral. But it is asymmetrical. Because those future workers didn't vote on those decisions. Yet they inherit them. This is how debt becomes political power. Not through control. Through obligation. Now zoom out. Globally, debt creates influence without occupation. A country doesn't need soldiers on the ground. It just needs exposure. Loans tied to infrastructure. Currency swaps. Development financing. On paper, it's partnership. In practice, it creates dependency. If repayment becomes difficult, terms change. Assets get negotiated. Policy aligns. Again, no evil intent required. Just leverage. The borrower needs stability. The lender wants assurance. Power flows toward whoever can wait. That's why patience is the ultimate financial weapon. The longer your time horizon, the more power you have. Short-term needs borrow. Long-term capital dictates. This dynamic isn't new. But the scale is. Never before has so much of the world's future income been pre-allocated. Never before have interest rates shaped daily life this directly. Housing affordability. Job stability. Government spending. Even social programs. All tied to debt servicing. And here's the quiet humor in all of it. The system is obsessed with confidence. But confidence is emotional. Markets move on belief. Currencies move on narrative. Debt markets move on trust. Which means the entire structure rests on psychology layered over arithmetic. A very expensive mood ring. So where does this lead? That's the unresolved part. Some argue debt can be inflated away. Others say growth will save us. Some believe defaults are inevitable. What's clear is this. Debt has already reshaped economic power. It determines who negotiates, who compromises, who waits, and who panics. It decides which problems get addressed and which get postponed. It doesn't announce itself. It doesn't march. It doesn't shout. It just compounds. So the question isn't whether debt is good or bad. The question is who controls it, and how long the system can pretend control isn't power. Because one day, the spreadsheet doesn't update. And when it stops, someone finds out who is really in charge.